Good morning, it's Jeffrey Cohen. It is Thursday, July 28th, and we're here to talk to you about the markets. The Federal Open Market Committee had its meeting yesterday, and they produced its results. And wow, did the stock market go up! It is amazing. Look at these percentages. Google up 7.75%. I mean, people can make a whole year's worth of earnings on a day like today, a day like yesterday. Or lose everything. Microsoft up almost 7%. Apple up almost 3.5%. I mean, these numbers are enormous. Blackstone up over 4%. Ameriprise, who knew, up 6%. So these are tremendous gains in the market. Walmart up almost 4%. So I don't even know where to start today. So I'm going to start at the beginning. So I want to leave you with a few thoughts. Just to start it off, what did I see? What I saw, because I did some prep this morning. Very, very, very large gains in US equities. These are multiple standard deviation moves. Big percentage gains. Not everything moved, not everything went up, but a lot went up. It was crazy. By the way, the VIX, which is the price of insurance against large stock market moves, the VIX is down 6% today. So equities went up, but the measure of how much equities are moving went down. It's very interesting. Global equities were up too, we looked. US Treasuries, fixed income, are at very strong levels. So if you have long duration investments, bonds, 10 years, 30 years, they're doing just fine now. They've actually recovered from their June lows, and raising interest rates has actually lowered or kept stable long-term interest rates. So your commodities are all up, priced in US dollars. Copper, gold, silver, crude oil, these are all up. And one of the things that I'm noticing is that the US dollar slightly weaker, but it's at a very strong level. And so we have a very strong dollar, which really punishes the US economy. But when the dollar weakens, things that are priced in dollars can go up in price. And so strong dollar actually could help us with inflation if we're importing things that we consume. If it's just stuff that we make and sell in the United States, it doesn't really matter. So those are some notes. And I'm going to show you what I see, but realistically, there's a lot going on. Ran the models last night again, and yeah, I'm always amazed by it. Just always amazed by what we learn. So let's just run through. You could see the markets yesterday. You know, they were up. They were actually up from like 7 in the morning. So people were making bets on the stock market early yesterday. And then it just kept rising, and then it rose all the way through the Federal Open Market Committee meeting. And I remember 2 days ago I told you that large cap, high liquidity stocks were sold off. And then they were bought back. So this is really just a snapback of large growth stocks. You can see it here, actually. Down here at the bottom. Large growth stocks are up 3.9% yesterday. That's exciting. That's tremendous gains, right? Take a look at bond market activity. You see advancers were ahead of decliners. This is the point. Interest rates, lower interest rates on a day when the Fed was going to be raising interest rates. So there's a little contradiction here that I think is very important. As the Federal Reserve raises interest rates, short rates, or what we call policy rates, the market kept long-term rates or long duration rates low as well. So our hypothesis, it's a recession warning, right? It's a flight to safety. But yesterday's stock market action does not reinforce that. So bond markets, you could see advancers beat decliners 3-1. What's interesting is you still had 3 times as many new lows as you had new highs. So that's the other thing I noticed. New lows are moderating, right? And so for fixed income, it's 3-1. And my guess is for stocks, it'll be low as well. So I noticed like the exchanges, US Equities. So when you see the composite, the NASDAQ composite up 4%, that's a big move. That is a, I don't even have the words, I'm sorry. The VIX down by 6% is also one of those mind-boggling moves. So you take the VIX, you divide it by 19.2. So roughly speaking, you're at 1.33%. That's basically saying the standard deviation of market moves is 1 1/3%. So for the S&P 500, you had a 2 standard deviation move, which is 95%. All moves, if they're random, 95% of them should fall within that range. It's a big move. It was a big move. And the NASDAQ, you're at a 3 standard deviation move. If you assume VIX equally covers NASDAQ, that just says nobody cares, right? But you see Europe was up. Hang Seng was down, which is interesting. Nikkei was up. Mainland China's up. Australia's up. Jakarta. By the way, we love Indonesia. We love the Indonesian people. Malaysia's up. Indonesia's up. New Zealand's up. South Korea, another great people. They're up. You know, I've never done business in South Korea. That's a country I've missed in my travels. And so, generally, their clients didn't spend on U.S. consulting, and so just never really got there. Futures, interestingly enough, the small caps look like they're going to try to rally this morning. They're up, but the rest of it's down. I guess people are digesting the changes yesterday. Currencies, I'm a little confused. So we're actually back. I'm sorry. That's noisy, and you don't need to hear that. Excuse me. I'm sorry. The fan kicked off in the HVAC. My bad. But so we're back down towards $1, right? Towards parity. So U.S. dollar at a strong level, and actually it's strengthened against the euro. But weakened against the Japanese yen. I find that odd. I find it also odd that it's strengthened against the renminbi, or pronounced won or renminbi. So that's interesting to me because those are big trading partners. Mexico, it's strengthened against the Mexican peso. Where's the Canadian dollar? I gotta look somewhere else for that. That's just odd to me. But the Mexican peso, and we're gonna go look at this crypto thing is worth a whole nother conversation. I wish we had more time this morning. Oh, there it is. 128. It's not bad. It's flat against that. It's flat against the Canadian dollar. So our main trading partners, right? And so I just worry, what does it mean? Why is Europe weak, right? That's a question. And by the way, why are the European banks weak? So this was something I noticed yesterday. European banks weak. I think they have some exposures that maybe they shouldn't have. So we talked about the futures. We talked about the enormous moves in stocks. What that tells me, right, when I look at the whole stock market thing, these are huge percentage gains. This could be covering shorts. Margin calls on shorts. It could be. It could be hypothesis. It could be that. It's hard to know. It's really hard to know what's going on in this market. Yesterday morning it just shot out of the gate super fast, super high. So that's interesting. One second. Cat cameo. Coming up. Come on, man. I know. So this is Pumpkin Spice. Pumpkin was out hanging out with the chipmunks this morning. So, I was going to say the whole crypto thing. So you take a look at Bitcoin. So Bitcoin bounced off of its support level. And this is something I find a little odd, right? Because you had different support levels in Bitcoin, right? You had the 40,000, then it came down pretty quickly to 30,000, came down pretty quickly to 20,000, and now it actually has been bouncing up and making a recovery, pretty strong recovery pattern into, it's fighting, but I don't know yet whether it's going to hold, right? But 23,000. And so Gregory Jones suggests that crypto is like fiat squared, right? It's a second order effect. And so, but with a dollar being strong, I wonder if the Bitcoin thing, it's just hard to know. I'm not an expert, so I'm never going to claim it to be, right? But I wonder if Bitcoin is a function, f of x. And I like the idea, right, of US dollar squared. I could play that a little bit. And one-day market returns. And maybe something like one-day market returns and a function of implied volatility. Because people are investing in Bitcoins to make a profit on the moves. They're not investing necessarily in Bitcoin to hang on. There are some people that just want to hang on to Bitcoin forever, right? But it's the moves, right? So is it volatile? And so it could be autoregressive. And that because we're in a move up, it's going to move up. So there's probably something there. It's just something's going on. But I think it just shows people are feeling like they want to take some risks, right? So I know we talked about copper up, we talked about silver up, we talked about gold up, we talked about crude up. I mean, the 30-year bond's a little weaker, but at 142, it's very strong. At the 10-year at 120 is very strong. So you're looking at a market with very, very strong, U.S. Treasury long duration. So, by the way, that's good for the banks right now. We got a whole thing on U.S. banks. If anybody wants to collaborate on that, that's something we'd be willing to work together on. We just ran our model and did a whole bunch of analysis on U.S. banks, regional banks. There's a lot there. I could probably make $1 million just on some bets on the banks. I feel like there's really a lot there. Let's see what the basic news here is. What's interesting is Ant Group. There's a lot of stories about what's happening out of China, but I don't know that anybody really understands it. There's a lot of... maybe this is it. Funds are furious as Powell pours gasoline on the most hated rally, forcing panic buying. I love it. Forcing panic buying. I mean, why else would people bid up the price, 6%, right? Tesla. It's crazy. By the way, there was a conversation about COVID. Oh, I should talk about what I did last night. Take a look at that. Hospital admissions, 6,500. They are creeping up. We talked about this. Slightly elevated, but also slightly flat new cases. But a lot of new hospitalizations. And so this COVID chart says we may not be over. May not be over. We may not be over with COVID, by the way. All right, 10-year treasuries, yields lower this morning. I'm amazed at the strength, right? But short-term money, 1-month treasuries, looking pretty good at 2.1. It's not at 2.15. It actually was higher. Go look back a month. 2.15 was the peak. We're still pretty good on short treasuries. 30-year treasuries are just holding their own above 3%. This is interesting. I mean, they peaked at 3.25. You know what? It's still pretty high. It's moderating, right? And so you've got moderate to high long U.S. treasuries. Let's see what it did to the mortgage-backed security market. The Fed's been buying a lot of mortgage-backed securities. I noticed. I want to thank. There was a guy on Twitter. I just started following him who shared this info. Let's see if I can find it. I probably won't find it. U.S. Treasuries, banks. That would be in my bank due diligence. So hard. There's always so much information. No, I don't have it. All right. So what it is it's the Fed shows their activities, right? And so the Fed is still aggressively buying mortgage-backed securities, like each week. And look at that. The 4.5%, the 5% is up. The Ginnie Maes, which have a slightly different structure, they're flat. They're not necessarily up, but at least they've flattened. Could think of that as a flag pattern, right? When a market declines and then it kind of makes a little flag. It'd be better if the flag kind of curved up a little bit. That's normally a very bearish sign. And so, yeah, could be. It also could just be that the Fed isn't done buying mortgage-backed securities. But look at that. The 30-year fixed rate at 5.54%. It's not bad. They're making home prices more affordable. That's the big thing here, right? It's like you change everything. All right, so let's look at new highs, new lows are only 2-1. So that was the thing I talked about before, right? So on equities, it's 2-1. So we're not seeing this falling knife, declines, blood in the street. We're just not seeing it. I'm not seeing it. I didn't see it yesterday. Now, of course, right, it was a short covering rally. For me to spit in the face of a short covering rally. But yeah, we're up to 2.15 or like 2 1/6. Brio Direct. Yeah, we raised again on our model. So now I'm gonna. So that's fine. That's where the market is. Basically, it totally took me by surprise. To be honest with everybody, I was completely taken by surprise. I was not expecting the stock market to go up that much. That much. It's crazy. Okay? But let's take a look. I don't really want to show you all the banking stuff. That's my inside baseball. That's how I'm going to get rich today. Or this month. Oh, I need to show you the Federal Reserve. I need to tell you what they did. I know most of you probably already, watched the thing and know about it, but just for like students and stuff that don't know, I'm going to walk you through what the Federal Reserve did. So if we look at money managers are also like a second order derivative on equity prices because money managers are a function of health of investments, health of clients, and I would say it's market volatility if they know how to handle it. Capitalization of investors, liquidity of markets. It's probably a good start. So money managers are a second order effect. And so when we see money managers going up like crazy, and then we see early in the morning, 50-50, that says money managers are doing okay. Right? Don't cry for the investment bankers today. I guess that's how I'd say it. Interestingly enough, pre-market, our specialty retail and furniture, a lot of downs, but Etsy's up. It could be more short covering. I just don't know. Miners, physical miners, up pre-market, including gold. Interesting though. So your crypto's up a little bit too pre-market. I wonder if weakness in the dollar, but it's not. The dollar's really strong. Why would physical mining go up? Why are physical miners stronger pre-market? The only thing I could think of is short covering. Because the bet is the Fed is going to push us into a recession, which reduces demand for physical commodities. I don't know. It's one of those days where I'm not going to trade. I don't think I'm going to do anything like macro. Macro's crazy. I look at chips and semiconductors, right? They're down in the morning, but not all of them, right? This is I'm a little confused by the market, which is okay. Let's talk about the Federal Reserve and what they did. I was on the earnings call. I mean, not the earnings call. I was on the press release, and I would say it wasn't that interesting. It What was interesting is watching the stock market go up when all this happened. Right? That was interesting. So, spending and production have softened, but strong job market, strong unemployment rate. However, we have inflation. Of course, we're going to blame Vladimir Putin for all this. So, the committee raised the target range for the federal funds rate to 2.25% to 2.5%, and that ongoing increases will be appropriate. So, federal funds rate, no one really borrows at the federal funds rate. I mean, I guess if you've got to bail out a bank, right? But what's interesting is banks take in deposits, and they generally, at least the banks we follow, they're paying zero for their deposits. Long-term retail deposits, zero cost. In fact, and it makes me upset, a lot of banks are charging people a lot of fees to deposit money. So in fact, they make money on depositors. Zero. So why would a bank go to the Fed and borrow money at 2.25% to 2.5%? It's because they don't have depositors. Or they don't have enough depositors. So that's interesting. So that's going to hurt weak banks. But what this also does is it allows banks to raise the price of loans. So when you raise the price of loans and you're a bank, you love it, right? Especially if you can just raise a credit card rate. Oh yeah, here's a credit card. Oh, by the way, I just raised your rate. You already have a balance. It's an adjustable rate. I'm going to raise your rate. But it's interesting, right? So the banks are going to charge more interest, but I believe they're going to end up making fewer loans. The other thing that the Fed did, and I can walk through the details, is they're going to continue running off the assets that they hold. So one of the things the Federal Reserve Bank has done, total assets. The Federal Reserve Bank has built up an enormous number of assets on its balance sheet. It went out and it actually bought them for money. It took the money and it put it out into the banking system, creating reserves. And it took pieces of IOU paper. So right now it's at $8.9 trillion of IOUs that they hold. And what they're saying is that so that's a big number. You should look at that number and think 8.9 trillion is a really big number. That's a lot of pieces of paper, a lot of IOUs that the Federal Reserve Bank has. So it's going to reduce them. That's interesting. All right. So what does that look like in real life? Federal funds rate, 2.25%, 2.5%. What's interesting, I'll show you some inside baseball. Our model that we use, we've taken our risk-free rate up to 2.5%. And so we believe that a savvy investor can earn 2.5% on get that on risk-free money. And so they're basically just keep raising the risk-free rate. And so at some point, we're going to end up raising our model rate to 3% or 3.5%. But for right now, 2.5% is fine. Overnight repurchase agreements with banks, reverse repurchase agreements with banks at 2.3%. So the banks used to be earning 5 basis points on overnight money. Now, if a bank decides to not make a loan, they take in their deposits for free and they lend them overnight to the federal government and they earn 2.3%. And this is why 10-year treasury notes are not yielding as much as you'd expect, right? Because that's your best collateral that you can have. A 10-year treasury note is like gold, right? And so if you have those, you could drop them right in the Federal Reserve Bank's hands and earn your 2.3% overnight. I talked yesterday, I made a big deal about like car loans and stuff, right? But if you have non-performing loans, car loans, high-risk loans, it's not helpful. What else about the FOMC? So now here's the tapering of the asset purchases. So right now, July and August, the Federal Reserve Bank takes the first $30 billion a month of Treasury securities that mature, and it just lets them go. So when that IOU piece of paper matures, we're going to pretend this is a bond, right? It matures, the federal government just takes the money. That's fine. Puts it in its pocket. The rest of them, it could be $90 billion. It takes more pieces of paper, right? Oh, here you go. Here's $90 billion. Thanks. You paid me, I paid you back. And now I take more pieces of paper. But starting in September, it's going to be $60 billion a month. So the Fed will say, of my $9 trillion of assets, which is still a lot of assets, let's be honest, right? 9 trillion with a T. And they're saying 60 billion, I'm going to take the money, 60 billion, and I'm going to put it in my pocket. Take it out of the reserve system. And then the rest of it, I'll pump back into bonds. So that's US Treasuries. We're also doing the same thing on mortgage-backed securities. So today, mortgage-backed securities, the first $17.5 billion that mature, where I get principal payments, I'm going to put those in my pocket. Now, I'm the Federal Reserve Bank. I'm just going to basically destroy the reserves. I'm going to neutralize that money. Let's be honest, there's plenty of stuff they can do with that money, but they just don't pump it back into circulation into the banking system. But starting in September, it's going to be $35 billion a month. So here's the math. $35 billion market-backed securities plus $60 billion US Treasuries is $95 billion a month. Let's call it 100 to make it easy. So 100 billion a month. And so I got 9 trillion. The odds are there's 100 billion maturing. So each month I would expect this number to go down by 100 billion. So that means in a year it goes down 1.2 trillion. So from 8.9 to 7.7. That would take us to the level of where we were, if they actually do it, of April of last year. April 7 to be precise. So all that's doing is like tapering. It's not a massive sell-off. Just a taper. And that's it. And the primary credit rate, this is really a policy rate, is 2.5%. So 2.5% is the blinking light right now for the Federal Open Market Committee. And I like this document. It's so clean. It's so easy. And then you listen to the Federal Reserve Bank, and they took in all the questions and all the answers. And I think that's great. So What else do I want to talk about? I think I'm just gonna. I mean, I'll look at morning movers, right? Because people kind of like that. Um, I always like to look at the walking wounded. So let's just see if there's any, you know, opportunities. I am not going to talk about banking stocks. So it's interesting, right? The stocks that I've looked at that were down, it's kind of a mixed bag pre-market. So I'm not going to talk about how the market's going to doing. I'm just going to review what I found. What I saw. Oh, and there were some charts I saved last night. I just wanted to make sure. Here's one that we should look at. So Jeffrey, what is this chart? You're confusing me. No, I'm not. This comes from FinViz. These are all of the stocks in the S&P 500 that have a $200 billion market cap or up. There are percentage change lines, and the base is -1% yesterday, daily move, and the first line that you can see, first step, is 0. So anything above this first line means they went up. So 2 days ago, I showed you this chart, and pretty much everything that was big like this was below the line, fell in price. Yesterday, people jumped right back in to the largest, most liquid stocks. This is not a stock picker's rally. This is people pumping money into stocks that are already worth $200 billion or more. It almost felt like a flight to safety. It's just weird. I guess this is what you do when you have a lot of money. You pump money back into stocks that are already large so that you can sell when you need to. Let's be honest. I have stocks in my portfolio that are not liquid. I'll never get out of those. I may never get out of those stocks. I don't know how I'm going to get out of the stocks. They're trading like 10,000 shares a day. I got 100,000 shares, right? Oh my God, I can't get out, right? So that was really the thing I wanted to show you. And the other, I guess, just to flash it up, was last night. Bitcoin was at 23,400. This is last night before bed. Bonds were strong. So let's just do a quick review. July 27. I mean, today's July 28, but this is July 27 action. Huge gains in US equities. Multiple standard deviation moves. Maybe the hypothesis it was forced panic buying. Maybe it was margin calls. Or maybe it was just putting money to work safely in case the bear rally is a bull market. Maybe. Don't know. The VIX is down 6%. That is odd. That is a contrarian move. Global equities were up. US Treasury fixed income at strong levels. High prices for bonds and notes. Lower yields, but still elevated. Okay. As the Federal Reserve raises interest rates, short rates, policy rates, the market kept long-term rates or long-duration rates low as well. So interesting. This also could be a result, if I kind of spin the thread a little bit, of tapering accelerating to $95 billion per month. This makes bonds and notes, U.S. Treasury and mortgage-backed security more valuable. As there are fewer of them. It's an interesting thought. I don't know that I agree with it, but it's an interesting thought. This whole thing could be a recession warning, flight to safety, but still need to put professional money to work. Either proprietary funds, right? You think the guys at Goldman Sachs or Citadel are allowed to just sit at home and say, I'm not feeling very good today. It's a bear market. I'm not going to trade anything. No, you got to put money to work. It also could just be mutual funds. You have to stay invested. Or client managed accounts. You have to stay invested. You can't say I delivered you a 2% return in a 9% inflationary period. You got to take some risks. Copper, gold, silver, they're all up. Crude oil is up, right? So commodities are up. It's interesting. US dollar's at a strong level, and I talked about it. Strengthened against the euro, but weakened against the yen. Strengthened against the renminbi, strengthened against the Mexican peso, flat against Canadian dollar. And really, why is Europe weak? Is this the Putin gas shortage? I should say natural gas shortage because it's not liquid gas. It's not automobile gas. Money managers, right? They're a function of the health of investments, health of clients, things like that. New lows are moderating. These are the best numbers I've seen, right? This shows a strengthening. Sorry for the typo. No, strengthening of broad market index. Why are physical miners stronger pre-market? I don't know. It's the weirdest thing I've ever seen. So I wonder if a lot of this going back is it's short covering because the Fed's pushing us into a recession, which should reduce demand for physical commodities, right? Bitcoin is I'm not sure, but it appears to be rising out of its support level of 20,000. It's just so odd. And then lots of movement on the banks. That's one where you got to call us because that's probably our next big bet for US advanced. Is on regional banks. So I want to thank you for listening. It's great. There's always so much more I can share with you, but I think this is a good way to start the day. And if you like the video, please hit the subscribe button, leave a comment. I love when you do that. That's really helpful. And just be safe out there. Thank you very much.